Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, December 21st, 5 o'clock p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction since the market broke down after a combination of CPI and positive CPI, which we gapped up, but then had a negative reversal. And then the FOMC with their higher for longer message a week ago today. You can see over here on the trend gauge, market leaders neutral. Still quite a few stocks holding up, but with the market winds not at your back, they really don't make any progress. You can see a bunch of them up 2, 3, 4, 5% today, but those are coming after days where it was down 2, 3, 4, 5% for 2 out of 3 days. So not a lot of big breakouts to new highs. A couple that have been, one of them we sold half of today after it just got a little bit too extended. We'll go into that when we go through the tail of the tape. So leaders neutral, short term. Every video, we look at the 5 major indexes and where they are relative to their short-term 21-day, medium-term 50-day, long-term 200-day moving average. This and the combination of what leading stocks are doing lead us to determine how much we want to be invested in the market. Short-term, we are below, all 5 indexes below the short-term 21-day moving average. Mixed bag versus the 50-day. Can't get off of neutral because for 2 reasons. One, the slopes of the lines on all 5 indexes is still turning up, and we still have the Dow Jones above its 50-day moving average. Long term, slopes of the lines, all 5 of them lower, 4 of the 5 below the 200-day moving average. So we're on bearish outlook there. So what just happened today, I knew that this was coming. When you go down 5 straight days, and then we had a consolidation day yesterday. That was an indication that that 3,800 area was holding as support. And we got an overnight gap up at the open of 0.65%, followed through to the upside. And this is the relief rally that we've been looking for. So the question now is, where do we go from here? Every day, I start the day looking at what we own, ask myself, am I wrong? Where am I wrong? And we came into today positioned bearishly, knowing that this bounce was going to take place. So over the last 5 trading days, we gained 411 basis points, or 4.1%. We outperformed the S&P 500 by 4.1%. That's not sustainable. I knew at some point we would be giving it back. Today was the day when we gave back about 1.3% of that. So now we're into resistance. That's what just happened. Gap up, broad rally into resistance. We battled most of the day right along the 50-day moving average. We closed 1 point above it. And that's the first level of resistance. Right above there is the 8 EMA and the 21 EMA. So additional resistance overhead. I'll be asking myself the next couple of days, we're positioned bearishly. Is this just, and it may be very difficult to determine if we're on the right side. Are we correct being bearish? The action of the prior 5 days says absolutely yes. Yesterday we paused. Today we're bouncing. It's natural so far, but we'll take a look at what the fib levels are. If we can retrace up to half of what we gave back without really changing the trend to be lower, and then we look at what individual positions are doing, what the indexes are doing, what sectors are doing, what stocks are doing, to determine, are we wrong? Where are we wrong? What changes do we need to make ourselves right? So G6 up 1.8% on the day, S&P up 1.5, NASDAQ 100 up 1.5, Dow up 1.6, mid-caps up 1.8, Russell up 1.7. Global diversified 60/40 stock and bond up 0.82%. GROTECTION in-house up 0.18%. Let's get into the tail of the tape and the charts, but first let's get into the way we manage money here at Revere. I had a conversation with a guy on Twitter this morning, Ted, intern. We've formalized our offer to him. He's coming on board effective January 1st, and some guy commented, now you just have to get your CFA and you could write your own ticket. And I commented, you don't need a CFA to do portfolio management the way that we do it. What do I mean by that? CFAs are fundamental heavy, all avenues of finance focused, and it's fantastic knowledge that you're going to acquire going through that CFA program. Dan has passed it. It's a very difficult program. Michael started phase one of it, and Ted is going to start after a year. He's going to start phase one of it. But that's focused on mostly fundamental analysis, and we at Revere do a combination of fundamental and technical. Fundamentals, they need to be there for the stocks that we invest in. At a minimum, we've got to see big sales growth or something new to the new product, new business environment, new CEO, something new, some kind of a catalyst to make the stock go higher. And then we need to have the market at our back. Fundamentals will look best at the top. Fundamentals can look bad at the bottom when the stock starts to go higher. So we buy on technicals and fundamentals. We sell only on technicals. And that's why we're managed to get out of the way of a lot of these stocks that we were invested in 2021 that have dropped 80, 90%. The sales growth was there. They never got to earnings. So part of the fundamental picture was there. Rising interest rate environment, those stocks are going to go down. Uh, I've seen a lot of people trying to justify why they're still holding them because the story's still intact. You can hold on to a fundamental story all you want. If the price action does not support it, you better get the heck out of the way or you're going to get your head handed to you. So that's the way we manage money at Revere. That was my comment about you don't need a CFA to be able to manage money the way we do it. But my hat's off to anybody that wants to take on that undertaking to be a CFA. So here's the S&P 500. Let's take a look at a 5-minute chart here. Uh, these last two down days, 3,800 here is 3,800. You can see we stopped going down at 3,800 on Monday and on Tuesday. And then we gapped up today. And then 10 o'clock, consumer confidence data came out and it was positive. So that's good. You want to see consumer confidence, especially if we're supposedly staring a recession in the face. Add on to this that Nike had really good earnings last night. They didn't indicate that they were overly concerned going forward. Uh, compare that with FedEx, who reported and said they are all about cutting expenses. They've seen a slowdown again this quarter, and then Micron after hours reported saying their margins were very compressed. They're cutting 10% of their workforce. They're cutting expenses. So you've got kind of a bifurcated story there. There's going to be some things that'll hold up, and there'll be some things that won't. We've been discussing how the market will assign a PE to whatever earnings per share uh, the S&P 500 is slated to get by the analysts over 2023, and that's how they'll arrive at what they consider to be fair value or not fair value. Because whether we like it or not, if those institutions aren't on board, they're not going to push the stocks up, and we're not going to make money because we follow the trend. So that's actually part of what the CFA would be all about, paying attention to what's going on in PE ratios and macroeconomics and so forth. But as of right now, so Nike, good. Consumer confidence, good. FedEx, bad. Micron, bad. Regardless, we ran up. Nice move up to this 38.88 level, and then we started pulling back, and you can see basically between 38.71 and 38.90 for the last 5 hours, 5.5 hours that the market was open. Why is this significant? Because 38.77 is the 50-day moving average. Now, the 50-day moving average is still sloping higher. So it's possible that we could trickle higher and still stay under the 50-day until it flattens and rolls over. But right above there, by 0.3% is the 8-day exponential moving average at 38.90. Good trends ride the 8 higher. They also ride the 8 lower, if you can follow my cursor here. So the question is, are we going to pause at the 8 and continue lower? We're going to blow through the 8, then challenge the 21, which is at 39.24, should be down around 39.20 tomorrow. So that's another 20, 42 points to the upside, about another percent. And that also coincides with this big 3900 to 3920 area that was support while we stayed above it for 5 weeks trying to go higher, and then we finally broke below it on the 15th last week, the day after FOMC, the one that put the nail in the coffin of the rally, broke below the 21, and the slopes of the lines, the 8 and the 21, started to roll over, and now we're below them. So asking the question, am I wrong? We are very defensive. We'll take a look at what goes on with the 8 and the 21 relative to that. And we've got some buys in our pocket, including an index buy in the Dow. We can get back in lower on the Dow than we can when we sold it last week. And we'll ride that trend. If we go higher, maybe we rally. Maybe Santa Claus does show up and we rally all the way up to the 4,000 level or the declining 200-day moving average and take another shot at it, depending on what comes out with earnings for the rest of the week and early in quarter 1. We are in very clearly. I looked at like the 2-week period, a couple days before Christmas, the week after Christmas, and the first couple of days of the new year. And over the last 12 years, 10 of them have been positive. So even if it's just a tactical trade, I want to ride that trade higher with a low risk entry and participate in some of that upside. But as far as what we did today, coming into this first level of resistance, we took that opportunity to take. Let's go back to the 5-minute chart of the S&P. Uh, Here's the 5-minute chart when we started getting into this area where we were overbought little by little this whole way up. We did 5 separate sales of our SPXL. That's our long position to get out of that into resistance. This is still a market where we want to sell into strength and buy the strongest on weakness if we decide that we want to put money to work. Now, again, that could change over the next couple of days depending on what goes on with the indexes, with individual positions. But for now, into this first level of resistance, we took everything off that we wanted to into strength. That included Boeing today, which got extended. I know I'm getting a little ahead of things now, but Boeing was 2.5 ATR above its 21-day moving average. We cut the position in half from 3% down to 5%, or down to 1.5%, and just took our gains on that. Just you don't see a lot of charts like this where they're sticking above an area here. The volume patterns are fantastic. The relative strength is fantastic, but the market has been a sell strength uh, market. And I'm not going to be the one that decides when that ends. The market will tell me when that ends. But for now, I'm going with that trend. So let's move on to the NASDAQ 100. Uh, Same thing, pop off the bottom, still below the 80 MA, the 50, and the 21, the weakest of the indexes. Not a whole lot of good things to say on a day when it was an 87% up day. Tesla's still down, barely, extremely weak. But do notice that we have had a hookup from oversold on the indexes also. NASDAQ 100, S&P 500, not the blue line, but the black line trying to get through the blue line. The blue line is the smoothing line, and it's a 14-day stochastic. So that's also something we're wary of. We could just have a minor rally again. If we do, we'll participate in it. Let's go to the Dow Jones Industrial Average, the strongest of the indexes, right into the declining 21. Now, I talked about what we would do is buy UDOW back. We exited UDOW at 59.20 and 61.30. If this gets through the 21, it's at 58.36 now. So if it gets through there, basically we'll be able to get back in right where we exited, and it'll be versus the 21-day moving average. And our stop would be around the low of today or a break of the 80 MA. Notice the 80 MA, that's the purple line flattening out there. The Dow continues to be the strongest of the indexes. You can see that over the last 3 weeks. And again, that's a move to defensiveness, which is very typical of a market when you're concerned about something like going into a recession. And you can also see the stochastic hooked up on the Dow. So the Dow would be the place where we'd want to put money to work. Mid caps, MDY. Into the 50-day moving average installed right there. You got the 200 overhead, you got the 21 overhead, and we're sitting right on the 8 IWM. Right into the 80 MA, we got the 21 overhead, we got the 50 overhead, and the 200 overhead. But this ran into the 8, paused there, and pulled back a little bit. Note the terrible relative strength over the last 6 weeks in IWM. What else do we want to look at? We want to look at the dollar, certainly. Dollar up 0.25% today, hanging out near the bottom of this consolidation. We've got alerts set to see if it's going to go lower or try to break this ADMA that it's been trending under for all except for one day over the last 4 weeks. Weak dollar benefits the market. The dollar was up today. The market was up today also. This has been a little bit of a decoupling lately on what the dollar's doing versus what the index is doing. Before it was all about inflation, now it's all about valuations and whether or not we're going to have a recession next year. Next thing we want to look at is the VIX, and the VIX down big today, 6.5%. This is the area where we bounced last time on the VIX. It's also the area where we bounced back in August, also the area where we bounced back in March, April, and February. So a huge area here, stretched down under the 21-day moving average. We got above the 21 for 2 days last week during the beginning of the sell-off. Obviously something we're going to be keeping an eye on relative to what the overall indexes are doing. How about bonds? Let's go with PYX, the 30-year bond, up just a little bit today, basically kind of tracking what it did yesterday, but second day above the 21. So change in the short-term trend on yields to higher on the 30-year TNX. Second close above the 21, change to the short-term trend to higher yields there also. And coming off of oversold, we've got room to run there. How about the overall bond index? Let's look at BND. Uh, Higher by a little bit today. This is broad. This includes all kind of bonds, some junk bonds. It includes corporate bonds, all durations of treasuries. But let's look at junk bonds, JNK. This is where any concerns about credit defaulting will pop up, but a good day for junk bonds today. One close under the 50, but now that's three closes under the 21, which has rolled over. So we'll keep an eye on that. How did gold do today? Dollar was up, remember. Gold down, very typical. That correlation still intact, basically hanging out where it was after yesterday's gap up with holding that gap. Silver, same thing, inside day today after yesterday's gap. Despite gold and silver being down, gold stocks were up 1.2%. They did run into this declining 200-day moving average. It's been a critical level. We own a 2% in Nugget, which is 2 times GDX. What else do we need to look at? That's it. That's all the main index charts that we want to look at. Let's take a look now at the tail of the tape. So correction, nothing new there. Big spike in the put call today. Don't really know why. Like 2 million puts were traded within 30 minutes. I did have Connor, our new intern that's coming on board, point out that the put call, he read a study that it hasn't been as reliable because of the short-term dated options that we have all over the place now. We're going to do some research into that. So the put call, normally this would be considered high, but it just seems very strange with 2 million expiring within 30 minutes. It popped up from 0.9 to 1.6, settled at 1.5. There's the VIX at 20, down 6.7%. Fear and greed at 38. We're operating under the bear case with the break of the 21 and the rally failure. Here's the news at 10 a.m. about consumer confidence. There's the news about the Nike earnings sparking retail, one of the strongest sectors today, up 2.2%. Day count from 4.5 days up with one consolidation day to a very clear up day, one up. Friday, we've got PCI inflation data. My expectation was negative, well, really mixed today. Negative because we're under the all moving averages, but the short-term bounce likely. We got the short-term bounce today. Levels right around this support and resistance area, this 38.77, we got above it, closed right at it, between support and support resistance on the NASDAQ 100. Here's the action today, that gap up opening 30-minute base. Then at 10 o'clock, the consumer confidence, we broke out up to 38.89, and then 4.5 to 5 hours of a half range fight at the 50-day moving average. Uh, what was up today? Uh, Actually, bond prices up, but really not significantly. And bond yields, you saw what I showed. Um, they started out in that direction, but didn't end that way. But we did have 11 out of 11 sectors up today, featuring oils, retail, and base metals. Solars, all the solars gapped down today, but reversed pretty quickly and closed strongly. When you see an attempted sell-off in what has been a leading sector reverse itself, you got to pay attention to that. Enphase and First Solar bounced at the 50-day moving average, got back above the 21. On the downside, gold and silver, the only significant industry group that I saw that was lower. Here's our focus list. We'll go through these charts. Here's the portfolio changes we made today. I talked about selling SPXL, trimming half of Boeing, both into strength. That's what O trim means, offensive selling. Bottom line, gap up and rally higher, but heavy resistance overhead. So we'll see what happens when we run into that resistance starting Thursday. And then the question, of course, is, are we wrong about being on the bear side, or will the Santa Claus rally did today kick off the Santa Claus rally? And how do we get on the right side to participate in that? So now let's go to the focus list. Let's start off with those solar stocks. So you can see what I was talking about. First Solar and Enphase originally down big on the day early, bounced right at the 50-day moving average, right where you want it to. Here's Enphase ENPH. Same thing, little undercut and end up 5% on the day. Average volume, which is good for a holiday week. Good action there. Let's look at two more. Let's look at SHLS. Remember, we got stopped out of this when they did their secondary 3 weeks ago, down to the 50-day, still hanging around the 50-day. So it's really putting in this base, which was prompted by this secondary offering that they put in. Let's look at ARRY, a volatile one if ever there was one, but you can see holding around this 20 area, held the 50-day yesterday and back above the 21. So three of the top four solar stocks back above their 21-day exponential moving average today. Let's look at what we own. We already showed Boeing, sold half into strength, just holding a very small position on that now. Mobileye also had a good day. Holding, look how it continues to hold this ADMA on a closing basis. Yesterday closed below it by 0.3%. That's the only day, but continuing to do the right thing. TMDX, we 1% position in that. Also bounced at the 50-day yesterday, back above the 21 today. So that's good action there. And then we showed Nugget, which we own. Here's Nike, which had the big earnings move up. Now let's move this back to 2021. And you can see Nike had a big earnings reaction back in June of 2021, and it went on a nice run from 154 up to 174 before it started to create a new base. But we were in a very strong uptrend back then, completely different uh, type of market that we're in now. But we still want to get anything that's a gap up on our radar. uh, and you can see here's the gap up today, closed pretty much at the bottom of the range, not what you want to see. We'll have alerts set at the top of today's range and the bottom of today's range. It did clear a lot of this resistance, but you can see this 118.47-ish area over here. We got up to a little bit below 120 and pulled back, closed at 116. So this area is still acting as resistance over here back from August. And then we do our usual when we see a gap up on big volume. Uh, Note the sales growth, 17%, dwarfing the prior 3 quarters. That's really what the market got excited about, not necessarily the earnings growth of only 2%. And also look at it has a PE of 29 with sales growth next year of 28%, a one, basically over a one PEG ratio. That's price earnings to growth. Anytime you're getting earnings growing and you see that, you got to pay attention uh, to anything that's anywhere near a one. Okay, so we've got our alert set for Nike. Next up, Caterpillar. They announced a catalyst today with something they're doing with AI and a partnership that they formed. And this looks great. 240, 239.85 was the breakout. Above it, closed at the top of the range, relative strength at a new high, volume above average. Everything you would like in a stock, you saw at a Caterpillar today. How about its cousin stock, Deere? Also acting well, undercut of the 21 last week, nice move above it, no volume today, stochastic hookup. That looks good also. Looks like it's in a bull market, which we know that we're not. Exxon oils were strong today. Exxon back above the 21, sitting right on the 50-day moving average. Are these rolling over, or are they getting ready to make a new move higher? Everybody hates oil. I know that. But this may just be another pause, like the pause that we had here before a nice run, the pause that we had here before we had a nice run. Maybe we're getting ready to run again. Let's look at Crocs. I haven't talked about this one in a while, but that's a nice tight base, and possibly spurred by Nike, another footwear company. This was up 8.5% today on slightly above average volume. Has been hanging around the 21, but it got above 100 today. We want to set some alerts for this one. Stochastic hookup also. In a good market, that would have been a buy today. mRNA continues to hold up well since this gap up. It tested the pivot on the pullback. Uh, New closing high today, actually, since it had that news-induced gap up about a cancer, mRNA cancer vaccine above the 200 level. Now, MDGL, this thing I mentioned how, let's see if let's see if the ADMA can catch up to it. It's now gone from 200 to 290 in 3 days. Uh, Nobody's waiting on MDGL. The aggressive play would have been a day two higher high or the initial gap. We didn't do it. So now we'll watch it and see how it plays out. It'll form a base at some point. May have to wait until the actual earnings show up. Schwab, uh, harsh sell off on 12/13 along with the rest of the market, but 4 days of recovery. Granted, it's wedging, but the volume is light this time of the year, but back above the 21 and back above that 80 level. How about two energy drink companies? Monster, gap up, held it above that 100 level off the 21, stochastic hookup, and Celsius, uh, close at the low of the day, struggling to get back above the 21, still coming down on the stochastic. Halliburton and Schlumberger, the two leading oil services, 3 days up, bounce off the 50-day moving average. Volume, nothing to write home about, but the relative strength is there for the last week and a half. SLB, same thing, 3 days up, volume not there, relative strength up for a week and a half. ELF, one of the leading growth stocks in the market, uh, putting in like about a 4 or 5 weeks tight here. Uh, One close below the 21, two above it now. Stochastic has hooked up, never got to oversold because of the strength. Relative strength continuing to move higher along with the price since it had that earnings gap up. One of the best looking charts out there. Uh, Again, a move out of this tight consolidation with volume in a bull market would automatically be a buy. And let's wrap it up with AEHR, very volatile silicon carbide test systems, holding the 50-day and tightening up. This has been an extremely volatile stock, but finally starting to tighten up. You can see, you can draw a triangle here along the bottoms and along the tops and see if it breaks out. Uh, in the oversold area, which is where you want to see it, which means the energy is building for a run higher. And that's going to wrap it. You want to reach out to us? We'd love to hear from you. Email don@revereasset.com. You know what? I almost ended this video without bringing up my favorite chart. This is why we do what we do at Revere Active Management, get defensive when the markets are not in our favor, because you do not want to get caught in a negative sequence of return scenario when you're headed into retirement. I've had it happen to people in my family and other people who I know, their family, by either unconsciously incompetent or advisors that just had no idea how to protect their downside, or they just didn't care. But not going to happen to clients at Revere. There's times we'll underperform, there's times we'll outperform, but you won't get hit in the back of the head with a 2x4 the way you did in 2000 and 2002 and 2007 and 2008 if you're a Revere client. take care of the drawdowns, and the returns take care of themselves when the market gets back to being healthy. So email don@revereasset.com. Also my partner, Dan Stewart, dan@revereasset.com, where you can call 855-REAL-WEALTH. As we always say, it's not how much you make in the market, it's how much of that you can keep. And with that, we're going to wrap up Wednesday, December 21st. Don Vandenbord telling it like it is. Just the facts here at Revere. Thanks for listening and have a great day.